Just under an hour to go until the closing bell, and you're looking at gains across the board. Dow, S&P, and NASDAQ moving to the upside. Let's bring in Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Kathy, it's great to see you here. So on the equity side of things, we're looking at gains. Bond markets, at least a 10-year, pretty much holding steady today, right around 4%. What do you make of the activity that we're seeing today and really what we've seen play out over the last several trading days?
Yeah, I think the bond market, and to some extent probably the stock market, kind of caught between this dynamic of worries about recession, but the idea that, perhaps some of the worst is over. And so we've got still the prospect of Fed tightening, which could slow the economy even more down the road. But we've seen some resilience in terms of consumer spending, and that has left us in this kind of volatile trading range. But I think as we get closer to the next Fed meeting, there'll be those renewed concerns about, higher interest rates and what impact that has next into 2023 on the economy and on profit margins and, just in general the outlook.
Are the equity markets, Kathy, continuing to ponder when that pause comes, and should they stop?
Yeah, well, I think we're all pondering, right? So we've been talking about it's not so much a pivot, meaning a reversal or even a pause, but really the pace that we've been concerned about. So the Fed has really ratcheted up rates so fast in this cycle. On a rate of change basis, it's the fastest rate cycle we've had in modern history. And, it takes 12 months, maybe sometimes 18 months for those rate hikes and that tightening to work its way through to the economy. So we're really just starting to see the impact. We think that means the Fed will slow down at some stage of the game. Probably 75 basis points at the November meeting, maybe 50 after that, and then maybe starting to level off. And I think, though, the market is really caught in this kind of game of trying to figure out when that moment comes when there's a shift in Fed policy. And at this stage of the game, it doesn't look like it's in the near term.
So, Kathy, how is that informing your investment strategy if you have a short-term horizon versus a longer one, as you're mentioning some of these 12 to 18 months that we might see this play out in the economy?
Well, we think that from the fixed income side, investors should be really looking at the opportunities that are there in fixed income. We came into the year expecting rates to rise, and we're short on the duration, and now we think you should start extending, maybe gradually. But the fact is you can build a high-quality portfolio right now with treasuries, investment-grade corporate bonds, municipal bonds with very attractive yields we haven't seen in many, many years, 5-6% yields. And that's pretty attractive, I think, for a base of a portfolio. And that is kind of the way investors should think about it over the long run, not over the short run. You start compounding 4 or 5% or 6% over 5 or 6 years, that's a pretty attractive proposition compared to potential volatility you might see elsewhere in a portfolio.
Kathy, we spoke to Gary Cohn yesterday. He joined us for Yahoo Finance's All Market Summit, and I asked him what he thinks needs to happen in order for the Fed to get inflation under control. I want to play a quick bite with what he had to say.
That labor cost has not come down, and it's another area where the Fed is trying to get some response. They're trying to get businesses to not grow as fast. They're trying to get businesses to not hire as many people. Mm-hmm. But we saw, even in last month's unemployment report, we saw 3.5% unemployment. We still see non-farm payrolls growing. Mm-hmm. So the interest rate impact has not fed through to the business cycle yet. We're going to have to see job destruction if we're really going to see inflation be curtailed.
Kathy, that job destruction, I want to ask you about that. I know we just got your predictions in terms of what Fed policy is going to be, but if we see even further weakening than maybe the Fed is expecting to see in the jobs market, what does that mean then from a market's perspective?
Yeah, and I would agree that what the Fed is waiting to see is the pace of wage growth slow down. So it's running around 5% year over year right now. I think the comfort level for the Fed is 2 to 3%, which means we probably do need higher unemployment to reach that goal. and slower job growth. But this is a very, very strange dynamic, too. We still have 1.6 million people out of the labor force because of COVID and long COVID. And we just don't have the participation rate up. So I'm not sure that wages will fall as quickly as the Fed would like to see. And if that's the case and they keep raising rates, hoping to see wages decline and see unemployment rise, well, that's just going to squeeze the economy even more. And that's not likely to be good for risk assets.
Kathy, you mentioned the lag and all the data that the Fed is using. Is there something you'd prefer, an alternative gauge? And when do you think we'll actually see inflation cooling off?
Well, we should see over the next couple of months the year-over-year pace of inflation come down, because just looking at the rate of change versus last year, that should come down. And we're starting to see softness, as you just mentioned, in the housing market. That's going to feed through to lower rent down the road, but that takes a long time to work its way through. So, and we've seen, commodity prices come off despite all the predictions, OPEC plus, et cetera. Energy prices have really not accelerated. They've been falling over the last couple of months. So all that suggests to me that we will start to see some of the inflation figures come down, but the wage component may be a lagging indicator this time. So that's really kind of the combination of things. If the Fed doesn't call me and ask my opinion, but I think they should slow down the pace right where we are and take the cumulative impact of the tightening to date, the rate hikes and quantitative tightening, and let it cool off a minute, let it feed through and see where we are. Otherwise, we could just have a damaging recession that doesn't really do anybody any good.
And Kathy, for some of the stickier parts of inflation, like housing as well, how does that complicate the picture when you're really trying to navigate how inflation is actually faring right now?
Yeah, it's really an interesting mix this time around, because we've seen wholesale prices come down. We've seen producer prices, the rate of change come down. We've seen softness in certainly some of the other areas. But it complicates it because the Fed is no longer looking at their forecast, because their forecast was wrong before. Now they're looking at current inflation data, and that will lag the economy. So we're almost sort of manufacturing a recession or a downturn in order to get that inflation down. And the risk is it's more damaging than it needs to be to get inflation down.
Well, Fed's certainly saying they'd rather do too much than too little. We'll have to see what that cost ends up being. Kathy Jones, thank you so much for joining us this afternoon.